Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and this is our deep dive earnings analysis for Alaska Air Group's first quarter 2026 10Q filing, released May 7th. With me is Mike, our aviation industry analyst. Mike, we're looking at a quarter that shows some concerning deterioration in profitability.
That's right, Sarah. If we reduce this filing to one sentence, it's this. Alaska Air Group is caught in a perfect storm of external cost pressures while executing a complex integration, creating a margin compression scenario with limited operational flexibility. Based on this filing, Alaska Air Group is operating in late cycle peak conditions with early contraction warning signals.
That's a sharp assessment. Let's start with the material changes versus the prior year quarter. What jumps out immediately?
The headline number is brutal. Pre-tax losses widened to $317 million from $233 million in Q1 2025. That's an $84 million deterioration year over year. But here's what's more concerning from a unit economics perspective. While revenue grew 5% to $10.43 billion, operating expenses surged 7% by $245 million. That negative operating leverage is exactly what you don't want to see in aviation.
Walk me through the causality chain on that expense growth.
If fuel costs remain elevated as management expects, and if wage inflation continues at the current 10% pace we're seeing, then Alaska's cost structure breaks its historical relationship with revenue growth. That fundamentally changes the investment case from a margin expansion story to a margin defense story. The company is essentially running harder to stay in place.
What's management's tone telling us about how they view these pressures?
The MD&A language is notably cautious. Management specifically states, and I quote, "Future fuel cost expectations are highly sensitive to disruption in crude oil supplies and refineries, which have been significantly impacted by recent geopolitical events. We expect that fuel costs will remain elevated for some time." That's not temporary headwind language. That's structural cost reset language.
They're not sugarcoating it.
Not at all. They also explicitly called out that civil unrest in Puerto Vallarta and historic rainstorms in Hawaii reduced demand in key leisure markets ahead of the peak spring break travel period. These markets represent approximately 30% of Air Group capacity. When 30% of your capacity gets hit during peak season, that's not a minor operational hiccup.
Let's dig into the financial red flags. What's concerning you most on the balance sheet side?
The liquidity picture requires careful parsing. They report $2.6 billion in available liquidity, which sounds comfortable, but when you contextualize that against their $4 to $1.5 billion planned capital expenditures for 2026, you're looking at a significant cash consumption scenario. Their operating cash flow dropped to $421 million from $459 million year over year, while they burned $428 million in financing activities.
That's a concerning trajectory.
Here's the causality chain. If operating cash flow continues declining while capital expenditures remain elevated, then Alaska's liquidity cushion erodes faster than their 15 negative 25% of trailing revenue target range. At $10.43 billion quarterly revenue, that's roughly $41.7 billion annualized, meaning their liquidity target should be $6.3 to $10.4 billion. At $2.6 billion, they're well below their own minimum threshold.
What about debt levels?
Total debt sits at $5.6 billion when you combine the $523 million short-term and $5.08 billion long-term debt. Against a market cap that fluctuates with airline sector volatility, this creates meaningful leverage risk if margins compress further. Management targets debt to capitalization between 40-50%, but with losses mounting, that ratio deteriorates quickly.
Let's move to risk disclosures. Any new concerns flagged by management?
While no entirely new risk factors were added, the emphasis on geopolitical fuel price sensitivity has intensified. Management is essentially telling investors that fuel cost volatility is now a primary business risk, not just a cyclical headwind. They're also highlighting Boeing delivery delays as an ongoing uncertainty, stating Boeing continues to experience aircraft delivery delays attributable to supplier availability, production challenges, and regulatory approval processes.
How does that impact their growth trajectory?
It creates a capacity planning nightmare. They have firm orders for 174 Boeing 737 aircraft through 2035 and 12 Boeing 787s through 2032. But if deliveries remain unpredictable, Alaska can't optimize their network planning or revenue management. That uncertainty compounds their cost pressures.
Let's examine their liquidity position more closely. Are they in stress territory?
From a cash flow standpoint, they're managing, but with declining margins for error. Operating cash flow of $421 million sounds reasonable until you realize they used $428 million in financing activities and $169 million in investing activities. They're essentially burning cash faster than they're generating it operationally.
What about their credit facilities?
They did exercise the accordion feature on their revolving credit facility, boosting total liquidity to $2.9 billion post-quarter. That's prudent liquidity management, but it also signals management recognizes they need more financial flexibility. They also mention $20 billion in unencumbered assets, including 124 aircraft, which provides financing optionality.
Now, let's break down segment performance. Where are they winning and losing?
The segment story is mixed but revealing. Passenger revenue grew 4% to drive most of the revenue increase, but management specifically noted this came from higher yield from premium cabin demand and strong managed corporate travel, offset by temporary demand softness in Puerto Vallarta and Hawaii during the peak spring break travel period.
So they're seeing business travel strength but leisure weakness?
Exactly, and that's a concerning mix for Alaska's network. Their cargo segment actually performed well, up 25% or $31 million, primarily from improved Amazon ATSA economics with additional Airbus 330-300F aircraft. The loyalty program revenue increased 10% from their Summit Visa Infinite Card launch and expanded Bank of America partnership. But when your core leisure markets representing 30% of capacity are soft during peak season, that's a structural headwind.
What should traders and investors be monitoring going forward?
Management highlighted several key metrics. First, fuel costs. They expect elevated levels to persist, so any crude oil price movements or refining margin changes directly impact their cost structure. Second, Boeing delivery schedules for their 174 firm, Boeing 737 orders, and 12 Boeing 787 orders. Third, demand recovery in Hawaii and Puerto Vallarta markets, which represent that critical 30% capacity exposure.
Any guidance provided?
They're projecting $1.4 to $1.5 billion in capital expenditures for 2026 and maintain their liquidity targets of 15 negative 25% of trailing revenue with debt to capitalization targets of 40 negative 50%. But given current performance, hitting those targets requires significant operational improvement.
Let's test your thesis. What would prove you wrong about this late cycle peak with contraction signals?
Here's our if wrong clause. If fuel costs stabilize below $3.00 per gallon through Q3, while leisure demand in Hawaii and Puerto Vallarta recovers to pre-disruption levels, our margin compression thesis breaks down. Specifically, if Alaska can demonstrate operating leverage on revenue growth, meaning expenses grow slower than revenue for 2 consecutive quarters, then this becomes a temporary external shock story rather than a structural margin reset.
And how does this frame the valuation?
At current operating losses and declining cash generation, this equity trades like a turnaround story, not a stable cash-generating airline. The market needs to see evidence that Alaska can navigate through these external pressures while executing their integration without permanent margin impairment.
Revisiting your core thesis, does the evidence support Alaska being caught in that perfect storm?
Absolutely. The full weight of evidence from fuel cost pressures, wage inflation, integration execution risk, and leisure market softness confirms this is a high wire execution scenario with limited margin for error. Management's own language about expecting elevated costs for some time reinforces that this isn't a temporary dip, but a structural challenge requiring operational excellence to navigate.
That wraps our analysis of Alaska Air Group's Q1 2026 filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. I'm Sarah with Mike. Thanks for listening to Aviation Intelligence Weekly.